Are you ready for what's ahead? As the year passes, investors are becoming increasingly concerned about the possibility of a bear market revival. Will it strike again, sending markets to new lows by the end of the year? More importantly, how can you negotiate this turbulent terrain while armed with strong bear market strategies? Join us as we decipher the enigmas of the bear market and its impact on Bitcoin, cryptocurrencies, stocks, and equities, and reveal the route to survival. But before diving into more about that, let me first welcome you aboard for this episode of Finance Arc. On this channel, we set sail on a journey into the vast realm of financial matters, where we guide you through every step of the process and assist you in navigating the challenging world of finance, from simple budgeting advice to more advanced investing strategies. So grab your life vest and get aboard the Finance Arc. A bear market occurs when a market undergoes an extended period of price decreases. It is commonly used to describe a situation where the prices of securities decline by 20% or more from recent highs, accompanied by a widespread negativity and pessimism among investors. While bear markets are often associated with overall market or index declines, such as the S&P 500, individual securities or commodities can also be considered in a bear market if they experience a sustained decline of 20% or more over a period of typically 2 months or longer. In addition, bear markets can coincide with broader economic downturns, such as recessions. They are the opposite of bull markets, which are categorized by upward trends in prices. Imagine you're planning a road trip and you're trying to decide on the best route to take. You check different maps and apps, and they all give you different suggestions. Some say to take the scenic route, while others recommend the fastest way. It's confusing, right? Well, it's kind of like that with stock market forecasts for the year 2023. According to Bloomberg, the average forecast for the S&P 500, which is a stock market index that measures the performance of 500 large companies listed on US stock exchanges, predicts that it will end the year at 4,009. But that's just an average, and analysts have widely different opinions about where it could end up. Some think it will end at a low of 3,400, while others believe it could soar as high as 4,500. So what's going on here? Why are there so many different opinions? Well, just like your road trip, the stock market is influenced by many factors, including economic conditions, politics, and investor sentiment. These factors can change quickly and unpredictably, making it difficult to predict what will happen. But one thing we know for sure is that the stock market can be volatile and uncertain, and it's important to have a long-term investment strategy in place to weather any storms that may come our way. Imagine you're on a roller coaster ride, hurtling downwards at breakneck speeds. The wind is whipping past your face, and your stomach feels like it's been left behind. This is what it's like to invest during a bear market, a period of declining prices and negative investor sentiment that can make even the most seasoned investors feel queasy. But fear not, my friends, because there are ways to navigate this tumultuous market and even come out on top. Let's start with the first strategy: dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. The question for you is why this strategy can be beneficial during a bear market. Second, diversification. Spreading your investment across different asset classes, sectors, and geographies can help reduce risk. During a bear market, some sectors may be hit harder than others, so having a diversified portfolio can help cushion the impact. Consider allocating your investments across stocks, bonds, cash equivalents, and other assets to create a balanced portfolio. Third, focus on defensive sectors. Certain sectors tend to perform relatively better during economic downturns or recessions. These include utilities, consumer staples, healthcare, and essential services. Investing in these defensive sectors can provide some stability in your portfolio during a bear market. However, thorough research and analysis are still necessary to identify specific companies within these sectors that demonstrate strong fundamentals and resilience. Fourth, long-term perspective. It's important to remember that bear markets are temporary and eventually followed by recoveries. Instead of succumbing to short-term market fluctuations, focus on your long-term investment goals. Historically, stock markets have shown a tendency to rebound and generate positive returns over extended periods. So there you have it, some key strategies for investing during a bear market. Remember, while it can be a wild ride, it's not all doom and gloom. By using these tactics and maintaining a steady hand, you can weather the storm and even find opportunities for growth and profit. Have you ever wondered what happens to your investments during a bear market? Well, in simple terms, a bear market is a prolonged period of declining prices and negative investor sentiment, which can significantly impact various financial assets, including stocks, Bitcoin, and cryptocurrencies. During bear market trends, stocks tend to perform poorly, while Bitcoin and cryptocurrencies can experience rapid price drops due to their high volatility and speculative nature. So, what should investors check in such challenging market environments? First, speed and volatility. Cryptocurrency markets are known for their high volatility and rapid price movements. During bear market trends, crypto prices can plummet rapidly. This speed and volatility are inherent to the nature of cryptocurrency markets, making them prone to more pronounced fluctuations compared to traditional stocks. Second, speculative nature. Cryptocurrencies, particularly those with smaller market capitalizations or lower liquidity, tend to be driven by speculation and sentiment. The perception of market participants, news events, regulatory developments, and technological advancements can have a significant impact on crypto prices. This speculative nature can amplify both the gains and losses during bear markets, leading to heightened market movements. Third, lack of fundamental factors. Unlike stocks, cryptocurrencies often lack traditional fundamental factors such as earnings, dividends, or revenue streams. As a result, their valuation is heavily influenced by market sentiment, adoption rates, and perception of their potential utility. During bull markets, positive sentiment and optimism regarding the future prospects of cryptocurrencies can drive prices higher. Conversely, bear markets can be fueled by negative sentiment, regulatory concerns, or doubt about the viability of certain cryptocurrencies. Fourth, diverse market reactions. While there is a general correlation between traditional stock markets and cryptocurrencies during bull and bear markets, there can be divergent reactions as well. Cryptocurrencies are still a relatively new asset class, and their market dynamics are not entirely synchronized with traditional financial markets. In some instances, cryptocurrencies may act as a hedge or alternative investment, attracting capital during bear markets, when traditional stocks are performing poorly. Fifth, market maturity. The cryptocurrency market is evolving and maturing over time. As more institutional investors and traditional financial entities enter the crypto space, the market dynamics could become more aligned with traditional markets. Increased regulation, improved infrastructure, and the entrance of established players may potentially dampen the extreme volatility and align crypto market trends more closely with broader market conditions. Given these factors, it's important for investors to approach cryptocurrency investments with caution and conduct thorough research. The higher volatility and faster pace of crypto markets necessitate the diligent risk management strategy and a long-term perspective. Understanding the unique characteristics of cryptocurrencies and staying informed about market developments can help investors navigate bear market trends in this dynamic asset class. The possibility of a bear market hitting new lows by the year's end cannot be definitively determined. Market movements are influenced by a multitude of factors that can be difficult to predict accurately. While bear markets can be characterized by declining prices and negative sentiment, the specific timing and severity of market lows are uncertain. Are you ready to take control of your finances? Subscribe to our channel for more tips on savings and investments. Don't forget to turn on notifications so you never miss a new video. Let's grow our wealth together. Stay tuned!